They don't want to bring on capital to help scale their business when that capital loses money 70% of the time. You're running your balance sheet to zero every single month. That's a stressful way to live. That was the largest e-commerce acquisition in history when we sold it. But when we first invested in it, we were the only in-person meeting that they had. The 80% gross margin, highly recurring SaaS. The problem with Virality is it works both ways. Our default philosophy is the opposite of the valley. It's not discipline, just our DNA. If you're successful, you will have an investment that might return more than everything else you've done combined.
I'm Mike Gelb, and this is Consumer VC, where we break down what it takes to invest in and build scalable consumer brands and technology businesses. I know I sound like a broken record, but if you're enjoying this show, hit that subscribe button on whichever platform you're listening to the show on, whether that's YouTube, Spotify, or Apple, or a different platform. Also, sign up and check out the newsletter at theconsumervc.com. You'll get a weekly roundup of all the latest fundraisers, product launches, and just general consumer news. Also, you'll get new podcast episodes straight to your inbox. Please know that when you subscribe, you're helping us make more of this content. And I really do appreciate that. Our guest today is Larry Cheng, who is one of the managing partners of Volition Capital. Volition Capital is a growth equity firm established in 2010 that focuses on investing in high-growth, founder-owned technology businesses. Some of their investments include Chewy, have you ever heard of it? Or Chamberlain Coffee, Burst, and Grove Collaborative. Typically, they are the first outside check in the company, and they're currently investing out of Fund 5, which is a $675 million fund. In this episode, we break down their fund, their current fund, the stage, how they think about growth equity investing today, capital efficient businesses, which is a must-have for them in order to invest, and a whole lot more. Without further ado, here's Larry.
Thanks so much for being here. Thanks for coming on the show. How are you?
I'm doing great, Mike. Good to talk to you.
So great to talk to you. Let's start from the very beginning, at least in the beginning of Volition Capital's journey. What was missing from the market? Why did it make sense to start Volition Capital from the beginning?
Yeah, I think the market for growth equity was nascent. So there's probably three segments of private equity. I think broadly, sort of venture capital, growth equity being in the middle, and leveraged buyout being on the larger end. And growth equity, when I say that, it's talking about investing in companies that have revenue, customer traction, but have not taken the traditional venture path. And they've kind of bootstrapped their way or been very capital efficient about getting to some level of scale and product market fit. So figure our sweet spot might be 10, 15, 20 million of revenue growing 100%, but having done that without institutional VC. And there is a founder out there who has bootstrapped this company. They own most, if not all of the business. They never raised institutional money. And what they don't want to do is they don't want to bring on capital to help scale their business when that capital loses money 70% of the time, which is the venture capital model, which is you swing big, you lose 70% of the time, but your big home run makes up for everything. That's not great for the founder whose entire net worth is in that business.
It's captured in there, yeah.
Yeah, so we talk to our founders about helping them achieve their dreams without risking them, and helping them to scale to many times the size, because every day they're running the largest business they've ever run. And so we kind of fit in that zone for a capital efficient founder who after achieving some product market fit and revenue scale, is looking for that first media institutional round and a good partner to help them scale the business.
Do you find, because those stats have to be pretty impressive in order for you all to take interest in a company, right? In that they have to grow year over year over what, like 50, 80%? Is that right? At least?
Yeah, I would say the median growth rate is about 80, 90% at the time that we invest year over year.
Okay, got it. So, I mean, I'd imagine that these founders, just because they're growing at such a great pace, probably earlier before you all stepped in, which I think the minimum threshold for you all is about 5 million revenue, if that's right.
Yeah.
Probably they might have already have had offers potentially from VCs, just because their companies were kind of performing so well. What tends to be the reason why they actually reject traditional institutional capital at those stages then, before where it makes sense for you all to get involved and they've kind of achieved that $5 million threshold?
Yeah, so let me put this into two buckets. So the one bucket is what you characterized correctly. They had offers, they had interest, but they didn't take it and they scaled to 5 million plus. The other bucket is they just kept their heads down and they weren't engaged in the capital markets. And I would say that for a lot of folks, they underappreciate how large that second bucket is. It's the founder who's not in a venture hub, who's never raised institutional venture capital, who saw some problem and decide to sort of build this business on their credit cards and a couple of early customers and scale it. And they were heads down and they weren't looking for capital, and they're not connected to the capital markets. And so I would just say there's a good chunk of folks that are in that bucket, that second bucket. The reason they haven't taken capital is because they're not wired to take capital. They're focused on customers rather than capital. In the first bucket where they scaled is, I actually think it's a highly prudent thing to do, to take capital early in a business, pre-product, all the multiple rounds of seed and so forth. You're going to give up a lot of ownership for those dollars. And if there's a way to bring on customers rather than take that seed round, you might have just saved 20% of your cap table, right? And every time you do that, we save on that dilution. So that's another reason why is they're just wired to build the business more prudently rather than outside capital right out of the gates.
So, but how would you then engage in those types of in that second bucket? How then do you engage with those types of companies? Because if they're not interested in capital, they maybe had offers, but decide not to engage. That's just not them. They would prefer to bootstrap. Why then would they even take your calls?
Yeah, well, some do, some don't. To be fair, we reach out. We have analysts and associates and a team of folks here that we recruit early in their careers to reach out to companies, and they're reaching out to thousands of companies every single week. And so, to be fair, there's a number of companies that simply will not take capital and never. They're totally committed to bootstrapping. God bless them. We're totally supportive of that. But for others, you get to a certain scale and you're running your balance sheet to zero every single month, and that's a stressful way to live. And then your entire net worth is also in this business, which is totally concentrated. So it's another stressful way to live. And they realized, you know what? If I took a little bit of capital, it would give me the chance to invest in the business and to scale to have a larger outcome. Sometimes there's secondary involved in transactions where we give the founders some liquidity, and both of those can kind of hit the release valve a little bit to help the company scale more quickly, especially if you're working with a partner who has the experience to help you scale. So it's probably a combination of those things.
Are these then, since they decide not to take institutional capital, how in the kind of first innings, maybe pre-revenue or pre-seed, let's call it, that they decide not to, they decide to do instead bootstrap. How do valuations then in the stage you're investing? Is it typically, is the founder in a lot more of the driver's seat when it comes to what the valuation is? Is it not as great for the investors, for capital allocators like Volition, just because they've bootstrapped themselves? Obviously, running your balance sheet to zero every month, that's extremely hard to do. So there might be also leverage on your side as well, Volition Capital. But walk me through how you think about valuations at your current stage.
Yeah, so I mean, it's a range, because there's some companies that all the growth equity firms know about and all the venture firms know about, and everyone's competing and it's in the hottest sector, and that's going to be priced really high. But then there's definitely companies on the other end of the spectrum where we're the first investor they've ever talked to, and they've ever met, and maybe they're in a sector or a geography that or a business model that is not hot, but they've built a really nice business. And some of our biggest home runs have come in that zone of, while the business is performing well, there's something about it that, the market doesn't love. And, for example, Chewy was one of our best outcomes, our best investments in pet food e-commerce business. And you might find this surprising because that was the largest e-commerce acquisition in history when we sold it. But when we first invested in it, we were the only in-person meeting that they had. And it was not out of lack of effort from their side to raise capital. It was, but why? Why would a company that grew from, when we invested 70 million to a multi-billion in revenue, have no interest at the beginning? Well, it's because it's a low gross margin business, and it's in the pet food category, which had failed miserably in the dot-com bust. And so that was something that scared everyone away. So, we're not looking to check every single box. We're willing to take some risk on certain things and be contrarian within our focus area, and sometimes that leads us to less competitive opportunities, where at this stage we would value them usually on some sort of revenue multiple, or if they have earnings, some sort of earnings multiple.
How do you think about margin? I mean, because Chewy's pet retailer, yes, very, very slim margins, very, very tough businesses overall, right? And then, of course, you have, the dream SaaS businesses, right? Where like the margins are, 70, 80%. And these are kind of the darlings of venture, if I may say. How do you think about margin and as part of obviously the profile of a company that you might find interesting?
Yeah, so that's a great point. I would say at a highest level, we are margin agnostic. But if you're a lower margin business, you have to scale to be much larger, obviously. But that highlights a point that everyone in growth equity would love, including us. The 80% gross margin, highly recurring SaaS business that churns no customers, upsells 20% every year, with 120% net retention. Everyone would want that, and so do we. But there are great businesses that are considered low gross margin. When we invested in Chewy, its gross margins were 15%. That took them out of like 98% of funders, and so we understand how to make money at a 15% gross margin business, and we certainly know how to make money on a 90% gross margin business. And you have to think about scale and market size relative to absolute gross margin dollars available for that company.
How do you also balance just from a margin perspective? I mean, Chewy's is probably I would imagine like the thinnest margin maybe that you've maybe invested in just because it's a retailer, but just also thinking about even physical products that you invested in like Chamberlain and also Burst, which those are just because through the nature of being physical products, there's always margin. There's always going to be probably less margin there. I know that I'm generalizing here, but probably less margin than like your typical kind of pure software company. How do you balance that in your portfolio? And also in terms of outcome, because product businesses, like I'm just thinking about Chamberlain and also Burst, they typically aren't, winner take all as well. Businesses too. I mean, they're also pretty competitive. I mean, I'm just thinking coffee is I can't imagine how competitive coffee is, to be honest with you. And then also electric toothbrushes and also electric, it's funny. Electric toothbrushes, just thinking about it, it seems like there's only like a few handful of players. Maybe that's just from my consumer perspective and what I see at Costco. But it doesn't seem like there's a lot of kind of, it doesn't seem as much fragmented. That's what I'm trying to say. But I could be wrong about that. How do you balance this though? That's in physical products where the economics look quite different to software.
So the dynamic with particularly consumer product businesses, if you're in the zone of like a sub 50% gross margin business, obviously that's something that absent very super strong SaaS-like retention, you're working with a smaller LTV. And so your acquisition economics and your acquisition strategy from a customer perspective needs to not be as reliant on paid acquisition. Because then those acquisition economics through Facebook, Meta, Google, whatever, if those change, that can screw up your entire unit economics of the business. And so we tend to look for companies that have more, I would say, alternate approaches towards acquisition. Burst, being their affiliate channel, is they work with dental hygienists. That's still the driver of their business, where dental hygienists are the ones that are kind of repping Burst's products both online and in the office. You have companies that rely more on a complete referral, like Super 73. When we invested, their primary acquisition source was literally either current customers telling their friends or literally prospects stopping a customer on the street. This is an e-bike business, by the way, and saying, "Hey, that bike's amazing." And that was the channel. So we call that K factor. It's a viral coefficient. And where you can combine sort of virality with a lower margin profile, that math can work.
So if you have an edge in customer acquisition, like thinking about, Chamberlain Coffee, for example, who Emma has a very big edge when it comes to customer acquisition, does the product actually need to taste good? Like, does the product actually need to be incredible if you have such a great edge when it comes to customer acquisition?
Ironically, yes, we learned that through Chamberlain Coffee. At Chamberlain, we launched a product a ready-to-drink product in Walmart, and very early in the company's life. And it was a very healthy, ready-to-drink coffee, and it was almost too healthy. And so people flooded into Walmart because of Emma's influence, obviously, and visibility. But they didn't love the product. I would say it was a product that was more geared in hindsight towards a sort of a natural grocery channel. And so we moderated the product and relaunched it into Walmart, and that helped. So the problem with Virality is it works both ways. And if the product's not good, that's going to work against you.
Well, I mean, like, talk to me a little bit about even Chamberlain or even another example. Talk to me a little bit about the diligence side, and maybe separating the product itself when it comes to, the market, the edge when it comes to customer acquisition. How do you think about both sides of it in when you're actually thinking about making a consumer investment?
Probably two buckets again. Like, one is your paid acquisition strategy. How diversified is it? How consistent are the economics? How have the economics changed as you've scaled? So a great portfolio in that first bucket would be 3, 4, 5 channels. It's Facebook, Google, influencers, TikTok, social, whatever. You have a mix. You see consistency in acquisition, a CAC and acquisition economics as the company has scaled. And it's not spiking all over the place. So there's consistency and diversification there. And then in the second bucket, it's referral, a very strong referral base and brand. So those dynamics, that's something we diligence through customer survey work. We literally ask customers. We ask them how many times have you referred this? How many customers have you brought in? We survey prospects. We say, hey, does this seem like a fit for you? Would you buy? How often would you buy? And so forth. So there's diligence on both ends of that, just to understand whether this product has really found a seam and how viral that seam will be.
Do you have to like a product in order to invest in it?
Oh, me personally? No, I don't drink coffee. So,
or anything, not just coffee. It could be anything. It could be anything.
No, it doesn't. I care more about what the customers say, and so, yeah, as much as I like, I think the entire world looks exactly like me. I know that's not the case.
How do you think about, and what's maybe your definition of capital efficiency? I know that when I was kind of reviewing and thinking about what would be great kind of points or topics to ask you about, one of the kind of seems like cornerstones of Volition Capital is really about capital efficiency, and that's one of your kind of criterias in order for you all to make an investment or not make an investment. How do you think about capital efficiency when it comes to companies that you're sourcing and that you're looking at? And then how do you think about capital efficiency as well once you're actually in the trenches and you've already post investment?
Yeah, so pre-investment, we define capital efficiency. I mean, the umbrella is you really haven't raised your first large institutional round. So most of our companies have raised, I would say, less than $10 million, because then you get into the institutional world.
Are they profitable then, just because they haven't raised from institutional?
Many of them are, but some of them are not. Like, they've raised a seed round, they've raised friends and family, single-digit millions of dollars. They're not burning a lot. So most, like a high majority, are sub 10. And a good chunk of those have raised almost nothing. And so they would have to be profitable. Of course, there are businesses that they're SaaS businesses that have gone to 50 million of ARR. And if you do that on 15 million of capital raised and 8 million consumed, that's capital efficient for SaaS for sure. So obviously there's some variability in how we think about it depending on the business scale. Post-investment, capital efficiency is really at the highest level, using your dollars accretively. It's not that we don't want to invest, and it's not that we're unwilling to run a business with losses. It's just that investment has to be tied to strong unit economics, strong lifetime value, strong retention, those types of things. And our default philosophy is the opposite of the valley, which is you take our investment, and it's not like our default is to raise the Series B, C, D, E, and F rounds. The default is make the business work on the round that you have raised. Don't put yourself in a scenario where you need to raise a defensive financing because you're running out of cash. But if the company has warranted it, you raise additional capital because it's accretive. So what you'll see in our portfolio is a bifurcation where a good chunk, 2/3, 70% of the portfolio, the total capital raised will stay very close to the initial capital from our investment.
Wow.
And then for 20 or 30% of the portfolio, we think they've earned it. And they might raise 100 or 200, significant dollars thereafter. And just to be clear, both are going for it, but one is doing it with capital and one is doing it without it. And so that's...
That makes sense. I'd imagine I guess it depends on the consumer, but in the consumer business, I'd imagine that if it's a physical product business, I'd imagine it probably leans into maybe being the first and last capital from Volition Capital, that is not as much the like raising 200, 300 million. Maybe I'm wrong there.
Yeah, like I think most of our businesses have, as I mentioned, stay very close to that first round, that round of investment that we've made. And certainly when I think about our consumer businesses and our SaaS business, I can't say that there's a huge distinction between which ones raise capital and which ones don't, sector-wise. It's just that if the economics are accretive, we know how to scale capital into those, and if the market is there and so forth. But you can build highly valuable businesses by just compounding a business capital efficiently, and let time be your friend.
I know that you mentioned on the sourcing side, it's a lot of kind of outreach. You have your whole team outreaching to companies, thousands of companies a day. Do you get inbound? Do you ever I'm just thinking, just because, I imagine you get inbound, but in terms of the actual companies that you actually go on and make an investment in, since you're growing at that rate, I'd imagine you are maybe less likely to get inbound from these types of companies. But I'm just kind of curious in terms of what the ratio is when it comes to outbound and inbound, as looking at not maybe total number of companies, but looking at companies that you actually invested in.
I would say that over 90% of the companies we invest in are not just outbound. They are outbound outreach from an analyst or an associate. Sometimes like I might reach out to a company, or I come across a company. And so there's a small percentage that's inbound. And in those cases, there might be sort of an inbound investment banker that's working with them, but most of them are analyst associate outreach.
And what's a typical, I know like the kind of starter is, at least 5 million, I would say that they have to have in revenue. What's typically the amount that you deploy initially per company?
I would say call it 20-25 million is probably middle of the zone. These days, as we've gotten a little bit larger, it might move up to in the 30s. But I would say our range is sort of 15 to 50 is pretty covers most of it.
Have you found that this strategy has been a lot? I guess I should just back up and just ask, what's your opinion of this current market as compared to maybe the ZIRP years? Has it been easier, I would say, to get into companies, or or has it been a much more kind of investor friendly market for you, or I'd just love to kind of hear about how deals are kind of come together now versus in that era.
I would say, I'm not going to say it's easy, and it's never super easy. But yeah, in the low interest rate environment, in the years that we've come out of, what you had was tons of capital in the private equity markets, tons of capital in the venture markets. And so many things were getting priced up. And what has happened in the last few years is the largest funds who paid the highest prices have now seen those portfolio values retrench, and their capacity to raise capital also retrench. And also LPs aren't getting as much distributions because there's not an IPO market. M&A is softer. And so money's not going back to LPs, which makes capital raising even harder. So there's been a softening of fundraising, and that brings everything into more moderate zone. So in that sense, it's easier to guide companies to be capital efficient. It almost seemed hyper conservative, 5 years ago. And I would say the top end of the market has come down. Like your top SaaS companies 3, 4, 5 years ago, they might raise at 50 to 100 times ARR. Those are not happening anymore, at least to my knowledge. And so that has sort of retrenched into a normal zone, but deals are still competitive. And there are certainly still companies that we see like at 5, 6, 7, 8, 9, 10 term sheets.
Yeah, that makes sense. How during the zero interest rate environment where it seems like deals were just flying high. I remember talking to one investor says, I just can't keep up. Like these like founders like want like term sheets and like a week long turnaround, and they already have other offers. It's like totally bonkers. With your strategy of capital efficiency and then predominantly companies that don't have institutional capital in the early that have raised earlier rounds, which I'd imagine the types of companies that you look at actually probably I would think had offers. I know that as you said there are two buckets of different companies, but if you're going at that rate, I mean that's then and with the market as hot it was, I mean I'd imagine a lot of venture firms might be interested. But talk to me a little bit about how you're able to, with the strategy, maybe survive like the zero interest market rate, because it seems like your strategy in terms of the capital efficiency, like it all sounds like what a lot of ventures kind of preaching out today, but wasn't really. And maybe they were preaching out it then, back in back 2018 to 2021, but maybe weren't acting, maybe kind of not walking the walk. But during that time, how were you able to stay disciplined?
It's not discipline. It's who we are. It's just our DNA. Here's a simple piece of math for you. If you take a business and you invest in it, and that business compounds by 40% a year for 5 years, then you've generated a 5x outcome. That presumes there's no dilution and there's no change in multiple between entry and exit. And so I would say about a third of our historical outcomes, realized exits, have been north of 5x, which is a very good return. And so we view capital efficiency as a way to not just protect returns and protect the value accruing to shareholders, including the founders, but to create value. Because taking tons and tons of dilution and raising lots and lots of preferred stock can be a way to actually lose value. And so we don't view it as an outright good. In the ZIRP environment, yes, our capital efficiency mantra sometimes was not a great fit for certain sectors and types of founders. And no harm, no foul. If a founder wanted to go down that route, we wouldn't be joining them for it. And we're not a huge fan of like press releases for financings. What does that even mean? Like that just means you took dilution. So we just had to find the right founders that mixed with our strategy, and that was the secret sauce.
You mentioned how one of your biggest wins with Chewy, how that part of how that kind of came about was because it was a sector that was not interesting to the market. It was kind of an unsexy sector, with pet and also retailer, which is funny. I went to the Global Pet Expo a couple of weeks ago, and oh my gosh, it's just littered, no pun intended, which is incredible brands and like some really cool innovation that's happening. And it's interesting now that 10 plus years ago, how that was not kind of interesting or sexy at that time, which now it's just really, really kind of changed its tune. But what would you say right now are kind of the unsexy markets or sectors for VC that you're seeing?
How about consumer products?
Yes,
it's the most unsexy place. It's extremely hard. I'll walk through some of our companies that were unsexy at the time and then what's unsexy today. Like, I mentioned was a home run for us. Fanatics was a home run for us as an ad tech business. Everyone hated ad tech. Why? It's CPM based. Google and Facebook duopoly. Lots of roadkill in the public markets and ad tech companies. We have a great company called Creatio, which is a low-code software business in the CRM space. What was flawed or scary about them was when we invested, most of their revenue was in Eastern Europe and Ukraine and Russia, two great geographies. And this is pre-war. And our thesis was that they could come and scale here in North America, and they have. U.S. Mobile is teed up to be another home run investment. It's mobile services provider, so they could be your cell phone provider. And you should sign up for them, Mike. But what do people dislike about MVNOs, which is mobile virtual network operators? It's so many have failed. There's roadkill galore in historical markets, and so people remember that, and it becomes less popular today. So like, in broad swath and broad categories, like what becomes unpopular in markets today? Business models that are not the perfect subscription enterprise model, geographies that are considered off core, sort of business models that have had historical issues and lots of failures people don't want to touch again. Consumers in that bucket, anything with the lower imperfect financial profile, lower margin, growth is too slow, churn is too high, whatever it may be. Those types of things can be, it's almost like the market has narrowed its interest area. The perfect AI software business is what people want. And that's where dollars are flowing, which is why multiples are super high in that segment.
Right.
And everything else is kind of like, not as much anyone's cup of tea.
Do you think that right now, where we are with AI, as you say, we were maybe 10 years ago when it came to SaaS?
Yeah. I would say that's fair. Like, .com, mobile, SaaS, AI, like there's always appropriately an upswing and an interest and hype. But usually what happens is that the venture dollars flow early into the sector, drive up pricing before the businesses are set and the products are essential. And then the market settles into where you have real businesses with real products with real ROIs, and that can take some time. And I think you're seeing that in the AI market today. We generally have to wait for that first hype cycle to abate, and then come in later.
So as of now, you're not participating in AI. Is that correct?
No, I mean everything is branding itself as AI, but when I say AI, I mean like the pure play LLM, high CapEx, like that was okay. That the Valley's backing, but honestly, every software, even every consumer company we see, they'll pitch something AI related. It's almost redundant at this point.
Yeah, no, for sure. What about the product layer of AI? Maybe you're also referring to that, not like the LLM side, but the actual like products within AI.
Oh yeah, 100%. I mean, we will look at it. The challenge is with these early AI product and application companies is there's a ton of experimental usage, and so we're seeing, and we just talked about it today, we're seeing companies spike in revenue early, but the visibility on the recurrence and the stickiness of that revenue is hard. It's harder to know because you and I are trying lots of different AI applications, but not all of them are going into our entrenched processes. So that's the challenge today with some of the AI companies.
Yeah, that is really interesting. That is really interesting where you've seen spikes in AI because, spikes in AI, and then it's almost like they're bursting on almost like too quickly. It's interesting because just from how you said it, sometimes it feels that way. Sometimes in consumers, when it comes to brands, when it comes to a launch, for example, of a new celebrity launching a company, and I always think, how sustainable is it going to be with that product and the celebrity kind of attached to that product? Will it actually be like long lasting or long serving on that product alone, or is it kind of spiking too quickly and going too fast?
Yeah, I mean, I don't think that we would ever invest in a company based on its influencer attachment and its celebrity partner, absent just a core belief in the market, the product, the unit economics, and so forth, because you just can't bet the entire business on this one person staying sort of, in vogue and doing the right things. It's really challenging.
Yeah, totally. I also just think too, when it comes to exit potential, it might also get tough, right?
Yeah, right.
If it like, will strategics be as interested if a company is also kind of led by a particular creator? That person maybe has to be involved in some capacity. Well, they also want to sell the business. So how does that all, what's actually the true maybe value of the actual company itself? I think that sometimes it can get a little tricky.
Totally. That's fair.
I want to also talk about Grove Collaborative.
Yeah.
I'm sure you did very well on their investment. I would say they're one of several consumer companies that went public during the boom. And of course, like many consumer companies, kind of struggled in the public markets. They are certainly not alone. Your perspective, when is the right time for a consumer business, if it has the ability to go public? When does it make sense to go public? And how do you even think about, and is Grove's kind of journey, do you think that Grove maybe went public a little bit too early, or it shows like a risk in terms of going public too early?
Yeah, great question. Just to clarify, Grove is the one investment in all that we've talked about that actually does not fit our spec. And we actually invested in the company as a public company after it had greater.
Okay.
And so,
okay, wow,
okay, all good. So like Grove, I actually got to know back in the very early days. It was called ePantry, and the founder was Stu Landesberg. And it took a capital inefficient path. And so for that reason, we did not invest in it as a private company. The company went on to raise hundreds of millions of dollars, go public through a SPAC, and I think the company burned over $500 million prior to our investment as a public company. So, if you look at the stock chart and it like comes cratering down, we invested after it cratered down in a private investment in a public entity. And what we saw was a great brand, a great value proposition, battered in the public markets, and we're helping it with that turnaround, which is what we've done the last couple of years. I think it did go public too soon. It went, and all the companies that this whole SPAC approach enabled people to sort of quasi get public without having to go through the rigor of a true IPO process. And I think that led to some bad behavior, or not bad behavior, but like just going public too early. And that's why most of the SPACs have struggled in the same way that Grove has in the public markets. So when should consumer companies go public? Boy, you need scale and predictability, because you, as a consumer company in the public markets today, you miss once, like you're gonna get cut in half. That's like the risk reward of going public was almost not worth it. And that's why for us, it's only if you really know that you have a very consistent, predictable, and massive winner on your hands.
Did Chewy also though grow quite rapidly at maybe like a similar a similar pace?
Chewy grew even faster than Grove. I mean, Chewy went from 25 million revenue to 70 to 200 to 400 to 900 to 2 billion. But one distinction is because of Chewy's business model, even though we were running an EBITDA, quite a meaningful EBITDA loss as a private company, we were operating cash flow positive as a private company. So we were not consuming capital as we were growing, because we had a good working capital cycle with the manufacturers and brands that we were working with. So that's a bit different than a lot of other consumer companies.
Got it. Okay. Got it. So you're kind of locked in for a lot better terms, I guess, on the working capital side with your actual suppliers.
Yeah. In Chewy's model, we would actually get paid for products that we sold on our site by our customer before we had to pay our manufacturers for the product.
So you
pretty nice model.
So you have a negative cash
component of working capital. Yeah.
That's the dream. That's the dream. That's amazing. How also do you when you look at a company? I've had on VC before and talked a lot about they want to invest in companies that create new markets, that's new market creation versus companies that are in existing ones. And how do you think about when you kind of analyze new market creation versus existing ones, and when it makes sense? Because I know that you've invested in both, right? Companies that maybe have created new markets and existing ones. How do you analyze these two different types of companies?
It's ironic. In like consumer markets, I generally prefer existing markets. I much prefer better, faster, cheaper in an existing market than betting on a new market to come. And you're taking enough risk with consumer. I don't want to risk that the market doesn't even exist, and so I would say the newest market we invested in was Super 73, and the e-bike market in the US was nascent when we invested, but where we got comfortable was the e-bike market in Europe had become quite robust, and the ratio of e-bikes to regular bikes sold in the country had gone to basically in the continent had gone from like certain countries were 1-to-1 or 2-to-1 regular bikes to e-bikes, and the US was at like a 50 regular bikes sold to 1 e-bike sold. And so we thought that ratio was going to come down as it had in Europe. And we turned out to be right on that. But it was a new market in this country. Chewy was an existing market for pet food. US Mobiles is an existing market for cellular services. Burst is an existing market for oral care. We have greater comfort because at least there's big spend. You just have to go win it.
Yeah, and I guess you could also just say that it could be. I mean, I guess back to the original point: existing market, but new distribution, new way to distribute. With Chewy's, it was online. Not that online didn't exist before, right? But they were doing it in a new way, and maybe that the timing was much better.
Yes.
With Chewy's, and then as well as obviously. Chamberlain Coffee with their edge. Yeah. Chamberlain Coffee with their edge. And then as well as Burst with their edge in terms of actually going direct to hygienists and actually having them actually sell through that channel, which is just a whole new distribution channel for them.
I think that's right. There needs to be something that's the edge, because the thing about an existing market, obviously, is you have to displace an entrenched competitor. Like you have to win. A new market, you can win if you kind of are, who knows, you're probably quite not going to work quite right, then you might be able to be a leader for a while. So different risks, I suppose.
How do you think about when to exit a business?
That's a great question. I'll be honest. Sometimes we have sold way too soon. Sometimes we have sold way too late. So what we've evolved over time is at some time it's easiest to sell a business when it's doing really well. And we have taken some chips off the table along the way and rolled more. And so that's been a sort of a common reality. I mean, the reality is you have to leave something for whoever's going to own the asset in the future. And so, so you do look at your acquisition economics, you do look at your retention dynamics, you do look at your market size, and you stare at yourself and you say, can I see like 5 to 10 more years of growth and compounding in a capital efficient way? And if you're not feeling great about that, maybe you should start looking at the exit door, in the nearer term. So
how does that conversation go between you and the founder?
It's you might find it surprising. I haven't had a lot of sort of being on a different page with the founder on exit. One thing to remember is typically for our founders, their stock in their company is their biggest asset in their lives.
Right.
And they know that we've seen a lot of companies and gone through the full cycle of a lot of companies. If we're saying, we think this is a time or we think this is not the time, I think that will carry a lot of weight with the founder. And so that conversation tends to be a very productive one. And by the way, it works in reverse as well. The founder knows the company the best. They know the market the best. If they're coming to us saying, listen, I think it's time, will, of course, 1,000% be attentive to that as well.
But if you say to the founder, hey, we're actually going to take our chips off the table, or maybe we're going to exit this business, does that show a lack of confidence in terms of where the business is headed?
In the cases where we might take a little bit off the table, it actually sometimes helps to facilitate a transaction because these larger growth equity or private equity firms want to write a big check. And so that tends to not be an issue. And they totally get it because, they're on our side, us, in all their other companies. And so, but, over time, you just develop conviction in terms of your own perspective as an investor. And if a smaller investor wants to sell, that doesn't, when I'm buying in, that doesn't sway me one way or the other. And in the same way, if we're the investor that wants to sell, a good investor above us shouldn't sway them.
What's typically the time horizon of the fund in terms of when you want to actually pull your money out and actually make a return?
Our investment period in a fund, meaning the period with which we make new investments, is about 3 years. But then the fund life is about 10 years with options beyond that. So you're looking to sort of invest in the first 3 years and harvest over the next 7 years. I would say our typical hold period is probably like 5 or 6 years, but it can be as short as a couple of years to as long as 15 years in our history.
So you're able to have a pretty flexible or fairly flexible in terms of what the return profile could be.
The whole period.
The duration, excuse me.
Yeah, that's fair.
No, because it's interesting because sometimes when I talk to founders, I will say just that family offices could be a good route. Just because in consumer especially, it takes a long time to build in consumer. Like you don't quite have just from quite a few different reasons than from B2B. So having something that's having a vehicle beside you that actually can that is a bit more flexible when it comes to that return, that time horizon is much more useful, and a much better partnership. What's one book that's inspired you personally and one book that's inspired you professionally?
Professionally, probably the 5 Types of Wealth by Sahil Bloom has been a really interesting one. I've appreciated some of his perspectives and his posting on social. And my personal book is I read the Bible. Like I read the Bible every day, and that's has been my go-to for most of my adult life. So I'd say those 2.
Awesome. I'm so excited to add both of those to the book list. That's great. What is the consumer category that you're most bearish on right now?
Oh boy, that's a great. I mean, what can I pick from? Anything manufactured in China? It's almost impossible. I mean, to be honest, the last 5 years in consumer products has been so volatile and so hard. I mean, on one hand, it was hard because at the advent of the pandemic, lots of demand got pulled in. So we had companies that were rocketed up, and lots of there's huge demand for consumer products, and there was quantitative easing in the economy, and then it sort of normalized out, which is a huge pullback. And now you have tariffs everywhere, and so it's a challenging time because the ambiguity around our trade war is impacting every consumer company on the planet. And so I guess tongue in cheek, and if you're in China, I don't know how do you invest when there's 145% tariff sitting on it?
Right. Exactly. 100%. Has this with all these? I'd imagine with all these tariffs, they're asking a lot more questions in terms of when it comes to a company supply chain and actually where they're sourcing.
I mean, we always did, but this and doing some supply chain diligence in our investment and understanding our capacity within our existing suppliers and our diversification and so forth. But this isn't a great example, right, of what we talked about earlier. you said, well, why would a company that's growing super fast, doing super well, like what kind of attribute might scare all of the investors away? Well, what if you have a great consumer product company right now that manufactures 100% in China? Are you going to invest in that company even if the metrics are perfect? Now, some investor might say, I'm going to do it and bet that it works out, and in which case they might, it might be a great investment. But there's always something, because in this environment, there's a lot more variables to try and manage through.
Yeah, that's a very, very fair, very fair assessment. What is your favorite consumer product innovation over the past 5 years?
I'll marry all of the AI stuff with consumer products. Like the fact that my in-laws are driving around, they got a Tesla so that they could continue to be mobile and drive places without them driving. And the fact that my in-laws are driving around in a driverless vehicle right now is pretty mind-boggling. And the derivative of that into humanoids, I think, will be, and other types of robotics will be quite profound. And so I think that marriage of sort of AI software enabled consumer hardware has a lot of different applications, but that's been pretty profound.
No, that's absolutely. Even just seeing the Waymos around here in LA, it's mind-boggling.
Nuts.
Mind-boggling. Yeah, totally nuts. Within venture, what's the biggest thing you've changed your mind about?
Yeah. So what I realized through experience is that if you're successful, even in venture or growth equity, both markets operate to a power law. And that means that you will have, if you're successful, you will have a investment that might return more than everything else you've done combined. And then after that happens, if you continue to be successful, you'll have another one that will return more than everything else combined. So my first one of that was Chewy. I think my next one of that might be US Mobile. That might return more than everything I've done, including Chewy combined. And what you realize is that even within a capital efficient, growth equity oriented mindset, you want to invest in companies that you think can be significant and be that mover and impact company, because at the end of the day, that is what will drive the return in the economics to our investors. And until you have felt it, until you have seen one of these types of outcomes, you think you can dink and dunk your way into a great or overall performance. But in fact, that's pretty challenging. So I would say swing for the biggest outcomes possible, but without taking undue risk, is the marriage of our philosophy at Volition.
How then do you think about concentration in companies in relation to power law, in terms of, does it make sense to invest in less companies but you have a greater position versus more companies where you have less position?
I would say in our funds, our typical number of companies is 10 to 20. And that means that 10 to 20x returns the fund if the check size is normalized. And so I would say compared to a venture fund, that's probably pretty concentrated. And we don't have 100 companies in a fund or anything like that. But we can be concentrated because we have something to go on when we invest, which is customers and traction, unit economics, and so forth. And so, yeah, we are more concentrated by design, and we lose money much less than a venture firm would by design as well.
No, that's helpful. Do you think pattern matching helps or hurts when you're meeting new founders?
Oh, that's a great question. I mean, it's presumed to be default. Like, of course, I have pattern recognition, and that's in fact one of my core value adds, and why you get seasoned as an investor, is all of that pattern recognition. However, sometimes we as investors overly pattern recognize based on an N of one. It's like we had one portfolio company that went through that, whatever X. And so we apply that to every other company that looks similar. And that's literally a sample of one. There's nothing that says the world will follow that one company. And so, I'm very open-minded to the idea that the companies that we invest in might take a different path than the companies that we've already invested in. Some will overlap, some will not, and you have to be flexible to sort of tailor your approach to those two dualities.
I couldn't agree more. Couldn't agree more. What's your biggest myth about venture capital?
What's the biggest myth about venture capital? Oh boy. I've been in this business for a long time. I don't know. I may be biased. I am biased, but there maybe there's some perspective that VCs out there are kind of like these egocentric, sharp-elbowed, no user interface, capitalist-minded people that they're, and I don't know. I've been in enough meetings with entrepreneurs who will say, "Wow, you're like the most normal investor, nice guy that I've talked with," and I'm like, I don't feel like I'm like over-indexing on nice and normal, but they act like those who they've talked with are tougher. And most of the VCs and growth equity people that I know in the industry, I think they're good people, and I enjoy being with them. And so I wonder if the deep, dark, evil-minded VC is a little bit of a mix.
That's fair. That's fair. That's very, very fair. That's fair. Or maybe how they interact with founders is different. How they interact with other investors, right?
Yeah.
Potentially. But
and there you have it, Larry. Thanks so much for coming on the podcast. Thanks so much for listening. If you're enjoying this podcast, again, please hit that subscribe button, whether it's on YouTube, Spotify, Apple, and check out the newsletter at theconsumervc.com for the full experience. That's theconsumervc.com. Thanks for listening.